Today we're doing a complete breakdown of AASB 3. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before AASB 3, business combinations often hid essential details like acquisition costs and liabilities, leading to significant financial misinterpretations. Imagine acquiring a company for $100 million, but not fully understanding the assets and liabilities involved. By understanding AASB 3, you'll see how transparency in mergers and acquisitions reshapes financial reporting. AASB 3 came into play because mergers and acquisitions were often reported inconsistently, leading to financial opacity. Companies used different methods to account for acquisitions, complicating comparisons. By standardizing recognition and fair value of acquired assets and liabilities, AASB 3 provides stakeholders with a transparent view of a company's post-acquisition financial health. AASB 3 applies to all Australian entities involved in business combinations, effective from July 1, 2009, aligning with global standards like International Financial Reporting Standards 3. The core requirement is using the acquisition method, ensuring transparency by recording all acquired assets and liabilities at fair value. This standardization supports investors in making informed decisions by providing a clear financial snapshot post-acquisition. The acquisition method is fundamental to AASB 3, requiring identification of the acquirer and precise measurement of acquired assets and liabilities. Recognizing goodwill or a gain from a bargain purchase is crucial. Steps also include measuring non-controlling interest and consideration transferred. This approach not only ensures transparency, but also makes mergers and acquisitions more comparable, critical for analysts and investors evaluating corporate strategies. Scope is crucial, because overlooking exclusions can derail your analysis. Many assume all acquisitions fall under AASB 3. However, transactions under common control don't. Missing this can lead to costly missteps. Let's dive into the specifics, so you're never caught off guard. AASB 3 covers various acquisition scenarios that involve gaining control over businesses. This includes subsidiaries, where complete ownership shifts, and joint ventures, which require strategic accounting treatment. Remember, asset-only purchases aren't included. Clear understanding of these inclusions is vital to avoid errors in reporting. AASB 3 does not apply to asset acquisitions lacking business structure. This exclusion prevents unnecessary complexity. Transactions under common control also fall outside its scope, ensuring a clear focus. Recognizing these exclusions can be a differentiator in interviews and professional practice, avoiding costly reporting errors. A business combination occurs when an acquirer gains control over one or more businesses. This includes purchasing a competitor, where you take full control of its operations and strategy. It's not just about buying assets, it's about the power shift. Recognizing these nuances is key to applying AASB 3 correctly. The acquirer is the entity that gains control of the acquiree. Identifying the acquirer is essential for accurate financial reporting under AASB 3. Picture a large corporation buying a smaller competitor to increase its market share. The former becomes the acquirer, responsible for integrating and reporting the transaction. Consider these tricky scenarios. Buying a division that doesn't operate independently isn't covered by AASB 3. Acquiring just a patent portfolio or engaging in a common control merger also falls outside its scope. Additionally, if a joint venture doesn't result in control, it's excluded. Mastering these edge cases can set you apart in interviews. When two companies merge, the financial complexities can be daunting. AASB 3's acquisition method untangles this by providing a clear structure for reporting business combinations. It ensures transparency and comparability, revealing true economic realities. Imagine a merger where hidden liabilities surface later, impacting financial statements. AASB 3 helps prevent such surprises, giving investors confidence. The acquisition method focuses on identifying the acquirer, determining the acquisition date, recognizing assets and liabilities, and measuring goodwill or gain. We'll explore this using Meridian Corporation's $10 million SaaS contract with Acme Incorporated. This $8 million software and $2 million services deal illustrates how each step aligns to reflect true value and obligations, ensuring accurate financial reporting. Identifying the acquirer means determining which entity gains control. For Meridian Corporation, acquiring Acme Incorporated software and services makes them the acquirer. Missteps occur when companies overlook control indicators, leading to errors. AASB emphasizes assessing control through voting rights and potential returns. With Meridian as acquirer, we move to determining the acquisition date, recognizing the timing of control transfer. Determining the acquisition date is crucial, as it marks when control shifts. For Meridian Corporation, this follows their established control over Acme Incorporated software and services. A common error is confusing the signing date with when control legally and practically transfers. AASB dictates the acquisition date aligns with control transfer, impacting initial balance sheet figures. Now, we recognize assets and liabilities tied to this date. Recognizing assets and liabilities at fair value provides an accurate snapshot of financial position. Meridian Corporation's $8 million software and $2 million in services are valued as such on the acquisition date. Missing intangible assets like Acme's customer relationships often undervalues the acquisition. AASB ensures comprehensive recognition, impacting the balance sheet. This step sets us up for calculating goodwill or any gain from a bargain purchase. Goodwill represents the premium paid over net asset value, capturing intangible benefits. For Meridian Corporation, goodwill is calculated from the $10 million acquisition cost minus the fair value of net assets, revealing acquisition efficiency. Misjudging asset fair value skews this figure, a common pitfall. AASB emphasizes accurate goodwill calculation, ensuring it reflects true economic benefits. With this, Meridian's acquisition journey is complete. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Accurate measurement and detailed disclosure under AASB 3 are crucial for financial transparency. What choices are available and what must be disclosed to get it right? Initial recognition under AASB 3 happens when control is achieved, often the acquisition date. Identifiable assets and liabilities are measured at fair value then. Imagine acquiring a tech startup for $10 million. If the fair value of net assets is $7 million, the $3 million difference is your goodwill. Contingent liabilities only appear if their fair value is measurable. After initial measurement, goodwill isn't amortized but needs yearly impairment testing. Suppose contingent consideration, initially valued at $500,000, changes to $600,000. Remeasure it at the new fair value. Provisional amounts can be adjusted within the measurement period if new information arises. Handle other items as per their respective standards, ensuring consistency and accuracy in financial reporting. Goodwill finds its place under non-current assets on the balance sheet. Intangible assets, if identifiable, should be separately presented. Contingent liabilities, meanwhile, are detailed in the notes to the financial statements. Acquisition-related costs like legal fees hit the income statement as expenses. This presentation ensures clarity and aids stakeholders in analyzing the financial impact of acquisitions. Key disclosures help stakeholders understand the acquisition's strategic intent. Explain the primary reasons and expected synergies, like increased market share or new technology. Detail the fair value of acquired assets, such as a $2 million patent. Clarify how non-controlling interests were measured. Lastly, provide a qualitative description of factors contributing to goodwill, ensuring transparency and aiding investor analysis. Imagine a CFO overseeing a $15 million acquisition. The team identifies $10 million in tangible assets, like equipment, and $3 million in intangible assets, such as trademarks. This leaves $2 million as goodwill, which requires annual impairment tests. Acquisition costs of $250,000, including legal and due diligence fees, are recorded as expenses, impacting the income statement. This strategic financial management ensures accurate reporting and compliance with AASB 3. Meridian Corporation, a global manufacturing company, acquires a competitor, Apex Incorporated, for $25 million. This acquisition involves complex accounting under AASB 3. See how Meridian navigates each event, from initial recognition to post-acquisition adjustments. Meridian records the acquisition of Apex Incorporated by debiting investment in subsidiary and crediting cash. AASB 3 mandates recognizing the acquisition cost at fair value, reflecting the full purchase price. This impacts the balance sheet by increasing assets and reducing cash reserves. After acquisition, Meridian must recognize Apex Incorporated's identifiable assets and liabilities at fair value. This entry captures $18 million worth of net assets. AASB 3 requires these to be recorded separately from goodwill, ensuring transparency in asset allocation post-acquisition. The difference between the purchase price and the fair value of net assets results in $7 million of goodwill. AASB 3 requires this recognition, reflecting intangible benefits like brand reputation Meridian expects from Apex. Goodwill appears as an intangible asset, impacting the balance sheet. Meridian revises the fair value of acquired assets upwards by $1.2 million. AASB 3 requires adjustments if new information surfaces within the measurement period, impacting the investment in subsidiary account and ensuring assets reflect accurate market values. Meridian records $500,000 of amortization for intangible assets acquired from Apex Incorporated. AASB 3 mandates amortization expense recognition, reflecting asset consumption. This reduces net income and adjusts asset values on the balance sheet, showing asset usage over time. Goodwill is tested for impairment annually under AASB 3. Meridian recognizes a $2 million impairment loss due to a decline in Apex's future cash flows. This reduces goodwill on the balance sheet and reflects a more accurate asset valuation. Upon selling Apex Incorporated for $30 million, Meridian de-recognizes the subsidiary, recording a $2 million gain. AASB 3 guides this transaction, emphasizing the need to remove disposed assets and recognize any profit or loss, directly impacting income and cash flow statements. Every Big Four and investment bank interview on AASB 3 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A business combination occurs when an acquirer gains control over one or more businesses. Control is defined as having power over the business, exposure to variable returns, and the ability to affect those returns. Often confused with asset acquisitions, which lack the complexity of control. Remember, business combinations require recognizing all identifiable assets and liabilities at fair value. The acquisition method ensures all assets and liabilities are recognized at fair value, providing a clear picture of the financial position post-acquisition. It highlights changes in control, unlike purchase methods which can obscure financial realities. A common error is ignoring the fair value component. Key takeaway: it enhances transparency and comparability across financial statements. Goodwill is recorded as the excess of the purchase price over the fair value of net identifiable assets. Key is to accurately calculate fair values to avoid overstatement. Mistake to dodge, confusing it with other intangibles. Always check for impairment. Goodwill represents the future economic benefits of acquired synergies. Indian accounting standard and international financial reporting standards largely align. But Indian accounting standard includes more detailed guidance on accounting for common control transactions. International financial reporting standards focuses more broadly on fair value measurements. Candidates often overlook these nuances in intercompany adjustments. Remember, precise alignment varies by jurisdictional adoption, affecting financial statement comparability. Contingent liabilities must be recognized at fair value if they are present obligations from past events and can be reliably measured. Common mistake: treating them like provisions post-acquisition. Post-acquisition, international financial reporting standards requires reassessment of fair value. The key: recognition provides full visibility of potential future outflows. Purchase price allocation involves assigning fair values to acquired tangible and intangible assets and liabilities. Start by determining the total purchase consideration. Next, identify and measure the fair value of all identifiable assets and liabilities. Avoid errors in intangible asset valuation. Takeaway: accuracy ensures realistic goodwill calculation. Control in AASB 3 is an investor's power to direct activities, exposure to variable returns, and the ability to influence those returns. Misunderstanding often arises from focusing solely on voting rights. Real control considers contractual arrangements and other factors. Key point: control determines consolidation and financial statement presentation. AASB 3 excludes formations of joint ventures and acquisitions of assets not constituting a business. The common trap is misclassifying asset acquisitions as business combinations, leading to incorrect accounting treatment. Distinguishing factor: a business has inputs, processes, and outputs. Remember, asset acquisitions lack the complexity of control. The CFO must disclose the primary reasons for the business combination, acquisition date, fair values of assets and liabilities, and any contingent consideration arrangements. Overlooking key disclosures can mislead stakeholders. Ensure transparency in synergies and expected benefits. Takeaway: comprehensive disclosures aid stakeholders in evaluating the acquisition's financial impact. A common mistake is not adjusting for deferred tax liabilities, leading to overstated goodwill. Ensure the fair value of assets and liabilities considers tax effects. Missteps occur when candidates overlook tax implications. Memorize: correct tax treatment is crucial for an accurate goodwill figure, impacting future financial assessments. AASB 3 sets the stage for recognizing and measuring assets, liabilities, and goodwill in business combinations. It excludes joint ventures and entities under common control, but applies to all others. Key terms include business, defined as an integrated set of activities, and control, where an acquirer impacts returns. Goodwill represents future benefits and is critical for financial reporting. The acquisition method is key, requiring identification of the acquirer and measurement of fair value for assets and liabilities. Non-controlling interest can be measured at fair value or share of net assets, while contingent considerations are periodically reassessed. Goodwill represents the excess of consideration over net assets, whereas a bargain purchase results in a gain. Transaction costs hit the expense line, not asset values. Avoid key pitfalls like ignoring contingent liabilities or misidentifying the acquirer, as these errors can skew financials. AASB 3 parallels International Financial Reporting Standards 3, but watch for local application differences. Disclosures must capture acquisition specifics and goodwill details. Goodwill impairment is a critical test, especially in complex structures or step acquisitions. Provisional values can be used, but require prompt adjustments within the measurement period. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.